Friends, in today's video, we will discuss Quant Small Cap Fund. As you know, this is a highly reputed fund and it has generated decent returns for its investors in the long term. In fact, not just in long term, even in the short term, medium term, across every time frame, it has provided decent returns to its investors. The only exception is its 1 year performance. Last year, its performance was quite unsatisfactory. While the category has generated a return of 2% last year, this fund has provided a negative return of -8%. So in terms of 1 year performance, this fund underperformed the category by a huge margin of around 10%. But in all other time frames except 1 year time frame, in 2 years, 3 years, 5 years, 10 years, in every time frame, it has outperformed the category. So what suddenly happened that its performance was so disastrous last year? And is there any possibility of improvement in the future? And now that its NAV has fallen by around 10%, is this the right time to invest in this fund? That is what we will be discussing in this video. As discussed, this fund has outperformed category averages in every time frame and has generated decent returns for its investors in every time frame, with the exception of last year. So, to understand whether the fund's performance will improve after last year's hit, we need to look at its near-term performance. This means how this fund has performed in past 1 month, 3 months, 6 months and YTD. That is from January 1st till now. So if we talk about the last 1 week, 1 month, 3 months or 6 months, in these short time frames, the fund's performance is not worse than the category averages. It is performing close to the category averages. For instance, in the last 6 months, when the markets have been continuously falling and all the funds in the small cap category have seen declines in their NAVs. So during the 6-month period when the markets were falling, the category has generated returns of around -16%, and this fund also matched the category and also generated a negative return of 16% in this period. This means it is no longer underperforming the category. The same is the case with its 1 week, 1 month and 3 month performances. It is sometimes half to 1% below or above the category, just moving along with the category. Now if we talk about YTD returns, that is returns from January 1st till now, then here we see a silver lining in the fund's performance, where for the first time in the past year, it has outperformed the category averages by a decent margin. As in this period, the category has provided a negative return of 15%, while the fund has given a negative return of only 11%. So it has outperformed its category by 4% YTD, meaning from the start of the calendar year till now. So while the fund underperformed the category by 8% in the past 1 year, it has outperformed the category by about 4% from January till date. This is a clear sign that the fund is now recovering, and this is a strong indication because when the fund has been performing so negatively and then it recovered back to category's performance and even outperforming it. This indicates that a lot has changed in the fund. Its strategy has regained aggression and the fund is now appears to ready to provide decent returns in the future. Fund is likely to stage a takeoff from here. To know whether the fund will perform well in the future, it is important to understand why it has performed poorly last year. The reason for last year's poor performance, that was underperformance of 8% below the category averages, was the allegations of front running against this fund and the raids SEBI conducted on its officers. Due to these developments, the fund's reputation took a hit. Investors began to redeem their investments from the fund, and that forced the fund to say goodbye to its aggressive investment style. These circumstances forced the fund to follow a defensive investment strategy, had to hold cash and had to increase exposure to large cap stocks so it could meet the redemption pressures gracefully without further tarnishing its reputation. When these front-running allegations made against the fund house last year, it started holding up to 20% in cash, but now this cash holding has come down to 9%. This implies that the fund is gradually moving back towards its aggressive investment strategy. It is recovering from the setback it faced after SEBI's regulatory actions against the fund house. In the next section of the video, we will be discussing the fund's investment strategy and try to understand whether the fund is returning to its old aggressive investment strategy that has delivered decent returns in the past. As far as the fund's investment strategy is concerned, Quant Small Cap Fund and all funds from the Quant Mutual Fund House follow an aggressive investment strategy. The characteristic of an aggressive investment strategy is that it invests in high P shares and maintains a highly concentrated portfolio. Not many shares are kept in the portfolio to ensure that returns don't get diluted. After last year's front-running allegations, the fund's investment strategy became a bit defensive. Right now, the fund is in a recovery phase. Last year, the fund became completely defensive. Currently, it is not entirely defensive, but it is not entirely aggressive either, like it used to be earlier. If we discuss the fund's portfolio concentration, it currently has 86 stocks, while the category average is 85. So it is matching the category average, but this was not the case earlier. Earlier, it used to invest very aggressively. For instance, Motilal Oswal Small Cap Fund typically invests in only about 30 to 40 shares, and the same used to be the strategy of Quant Small Cap Fund. But now it has diluted this approach and has come closer to the category average. On the other hand, there are many funds in the small cap category that have over 200 stocks in their portfolio, like Bandhan Small Cap Fund and HSBC Small Cap Fund. So this fund is not as defensive as these funds are, but at the same time it is also not as aggressive as other funds that follow aggressive investment strategy like Motilal Oswal Small Cap Fund. Further, P ratio of the portfolio of this fund is at 23 at present, which is neither too high nor too low. So here too, fund is following a balanced approach. Fund managers don't want to be too aggressive right now, as the funds that invest very aggressively often have a P ratio of over 30% in their portfolios, sometimes even 50% or more. P ratio of this fund is only at 23, which means that the fund is applying a balanced strategy in its portfolio. Out of the total AUM of the fund, 91% is currently invested in equity, while 9% is either in debt or cash. This also shows a slightly defensive stance. As discussed earlier, they had gone up to 20% in cash holdings, which has now came down to 9%. But normally this range remains below 5%. So here too, the fund appears a bit defensive. The fund still hasn't returned to being as aggressive in its investment strategy as it used to be before the controversy of front-running broke. This defensiveness is also evident in their market cap allocation. For instance, the fund has invested 20% of its portfolio in large caps, while the category average is just 6%. So you can imagine how much more it has invested in large cap compared to the category averages. This shows that the fund is still not in a fully aggressive mode. Further, if we discuss fund's sectoral allocation, it has invested predominantly in services, healthcare, energy, financials, and construction sectors. These are its top 5 sectors. Even in this sectoral allocation, if you look closely, you will find that 2 or 3 out of the top 5 sectors are defensive sectors. This may prove a right choice that the fund is not showing excessive aggression presently. This ensures that if the market falls again, the fund's NAV doesn't experience a sharp fall and it continues to recover, thereby regaining the trust of its investors. Once this trust is regained, inflows will begin to pour into the fund. At that point, it is highly likely that the fund will slowly revert to its previous aggressive investment strategy in full swing and will start generating excellent returns once again for its investors, outperforming the category. In the next section of the video, we will be discussing whether this is the right time to invest in this fund. Now the question arises, is this the right time to invest in this fund? It certainly appears to be the right time to invest in this fund, as the fund's NAV still reflects the 8% hit it took last year. This means you are getting an opportunity to invest at a significantly lower NAV. In any kind of investment, whether it is stocks or mutual funds, this is very good opportunity when a stock or mutual fund NAV drops and then begins to recover and its NAV starts rising again. This fund has proven in its YTD performance that its NAV has stopped falling compared to the category averages and has started beating the category average once again. So this is generally considered a very good time to invest in any fund or stock when, after taking a hit in price or NAV, the stock or mutual fund starts to recover. Further, ever since the front-running allegations were made against this fund and its performance deteriorated last year, it has made several changes. Fund managers have been changed and the strategy has also been modified. Now the funds have become a bit more balanced in its approach and are now gradually shifting back towards an aggressive strategy. Also, if you choose to invest in funds that follow an aggressive investment strategy, then you need to understand that these funds are highly volatile. In fact, the entire small cap fund category is highly volatile. But within the category, the funds that follow an aggressive investment style maintain concentrated portfolios and invest in high PE growth shares are even more volatile. So you must be psychologically prepared to experience and tolerate that kind of high volatility if you invest in such funds. If you don't want to experience high volatility, then the Quant Small Cap Fund is not for you. In fact, the entire small cap fund category may not be suitable for you. However, if you can tolerate volatility and it doesn't trouble you too much, then you can consider choosing the small cap fund category. Even within that, funds that follow aggressive investment style tend to be more volatile compared to the category. The Quant Small Cap Fund also shows more volatility than the category averages. That means NAV of this fund will experience more ups and downs compared to the category as a whole. However, the reward for enduring this pain is that you will also get better returns. Mutual fund investment is a long-term investment, particularly if you choose to invest in small cap funds. And even within the long term, this is not a one-way process. Along the way, you may see 15%, 30%, or even higher drawdowns in your portfolio. So only if you are mentally prepared for that kind of volatility, then only you should consider investing in small cap funds. As if you withdraw your investments when there is a drawdown or market correction is happening and then reinvest it when the market goes up again, it becomes nearly impossible to create long-term wealth through investing in mutual funds. This video is only for educational purposes and is not an investment advice or recommendation. Always conduct your own research or consult a financial advisor before making any investment decisions.